Everyone, Weston Nakamura from Real Vision in Tokyo. It is FOMC day. I am currently live trading this event, and I'm getting decimated in my positions. Not all of them, but some of them. And so in light of that, I figured it would be a fantastic time to record myself getting decimated for all of you to watch. So, sorry, if I get distracted, by the way, it's because I'm looking at like 15 different markets at once. So it's actually me focusing on things as opposed to my usual, ADD drift away. Okay, so I attempted to live record, not live stream, live record. Does that make sense? Is it? It's not live if it's a recording, right? Is that how it works? I don't know. Either way, I attempted to record myself in real time. How about that? When the FOMC announcement came out, but that was just too much to handle because I was trading positions. So I just decided to regroup afterwards, but here I am during the actual announcement. Okay, so the hour is upon us for the FOMC to release their nothing. And you're going to see a whole bunch of algos kick in and move things around, even though there's no change and everyone's still with the real FOMC is when Powell takes the stand. Takes the stand. Was he in trial? I don't know why I said that. A market is already moving. Announcement would be nice. Okay, here it is. No change, 25 basis points. 10-year U.S. Treasury futures. Bottom left is 2-year U.S. Treasury futures. Upper right are June Eurodollar futures, and bottom right are December Eurodollar futures. These are kind of headline scanning algos that trigger one another. Let's just do a quick process to check. Jeez, that fucking 10-year is crazy. So crude hit 90 earlier. By the way, Bank of Canada also had a policy meeting, and they were expected to lift rates, and they didn't. I don't know how much impact that might have had leading into this. Probably approximately around 0, I would think. So far, I am 2 for 4. Let's regroup at market close, and we'll see what happened. Okay, so going into FOMC, I had 4 specific trades for this catalyst. So I am long calls on June Eurodollar futures. I am long calls on December Eurodollar futures, both for 2022. I'm long puts on VIX with a 20 strike. And I am long puts on 5-year U.S. Treasury futures. And then I also have that that pair trade that I discussed the daily briefing earlier this week, where I'm short XLK, the SPX tech sector ETF, short XLK, long Sony. But that pair trade, that market neutral pair trade, put that on a week ago, and that wasn't something that I had on specifically for the FOMC. That was just to play the downside market neutral hedged. That wasn't specifically for this. The other ones were. So the 2 Eurodollar calls, right? So I explained this before, but Eurodollars are this is not EUR USD. This is not currency related. This is not the euro. These are front-end, short-term interest rate derivatives. I was long June and December 25-30 delta out of money calls. So basically, I'm betting on the markets to price out some hawkishness. Not because I don't believe that 50 basis point rate hike to kick things off in March is possible or appropriate. What I was playing was sort of the broader crowded positioning, this sort of seemingly one-sided positioning of the Fed will be very, very, very hawkish. What that sets up for is a scenario in which if Powell came out and was indeed very hawkish, in line with market expectations and positioning, then you wouldn't really get that much more of a move, like sort of a hawkish like repricing, because it's already priced in. If Powell came out even like a slight bit like less hawkish, then that could potentially reverse all of the rate hikes priced in and all that kind of thing. And so it's not like a 50-50 coin toss, the way that I looked at it. So even if he actually came in exactly as hawkish as the markets had expected, you still might see a reversal, because it might just be like sell the news, like a profit taking and reversal. So I bought out of money calls on Eurodollar futures. June, in case like the imminent like sort of like we're gonna start hiking rates immediately starting next meeting, in case there was any sort of non-confirmation of that, the shorter dated expiries, the lower delta ones, would see more upside. And December one it sounds like the same bet, but it's not, because it's for December. And so that didn't work out because Eurodollars took a massive leg down, even after having already drifted down significantly, heading into FOMC. So what I did was I don't know like why I particularly closed out my June, but I did at like 70% loss. So that's why I was like, might as well, to close it out at 70% down means that I care about that other 30%. It also means that I'm crystallizing a 70% loss, and if I can't handle 100% loss, which I absolutely can, that's why I put it on in the first place. But if I can't, I shouldn't have put it on in the first place, right? So there's still a chance that it can swing back and well into profitability. The only way to do that is to leave it on, so I should have just left it on, but I didn't. I did, however, double down on the December calls because they got significantly cheaper. And this is just in case something happens in which Powell isn't able to just rip rates like 600 basis points or whatever the hell we're all expecting or he's espousing. So we'll see how that works out. Okay, so those are the two calls on Eurodollar futures trades. No bueno so far. And then regarding the VIX puts, so the reason I did that was because obviously, the VIX has been bid up in the last few days. We went from sub 20 to almost 40, in a matter of days. And so the way I looked at that scenario was that, I saw a very likely potential for traders who were eyeing all of that, like, implied volatility premium that's, like, sitting out there and, like, ready to just grab it as soon as the policy came out, regardless of what, not the policy, the announcement came out, regardless of what the announcement may be or how, hawkish or not, Powell in his press conference was. It was at least finally like the official FOMC certainty. It's not like this dark period of just kind of speculation and just a rumor milling around the markets and all that. This was actually the guy who came out and like said what he needed to say. And so therefore, regardless of what it was that he was saying, I thought that traders would come in and crush VIX back down. They did for like 17 minutes. and then they bought the VIX some more. And my puts are, let's see. Okay, well they were down more than that, but I'm down about 60% on the position. Good stuff. So 3 no good trades. And by the way, those are not the same trade either, right? It's not like long E-minis, and I'm also short the VIX or something like that, which would be like the same trade, even though also not really all the time, but more. You get what I'm saying, right? But you could very well be see a situation where like rate hikes would get priced out, so Eurodollars would move up, and simultaneously, for any reason, the VIX would get crushed. So, but none of those scenarios happened. So by me saying that they're not the same trade, it's actually worse because I didn't just get one thing wrong. I've gotten like a combination of things wrong simultaneously. Okay, now here's what I'll say though. This is probably the most important part of just trading in general, but especially like with this scenario, and this goes for all of my trades. The most important thing is not the direction, getting the direction, or the call right or anything like that. It's sizing. It's your position sizing. Like that matters way more, right? Like it matters more than getting the directional call right, because if you ever find yourself panicking about something that you hold, your size too big, right? Like this is how I'm able to just kind of be a clown like I normally am and laugh this off, because these aren't like joke paper trades or anything like that. I mean, they're real trades, but they're not like positions per se. I just kind of saw potential opportunity, like I explained before, and I executed them. And that's also about as much like thought and kind of effort that I put into each of those trades. Like it was maybe, I don't know, a collective 200 seconds of thinking of of it. And so I put 200 seconds of thinking worth of capital like into the trade. And so if you put like that little effort or like time or thought into it, then you have to kind of accept the fact that they're probably gonna go to zero, and deservedly so. And so if that's the case, you have to be okay with it going to zero the second you hit your buy button or your sell button. And as long as you're okay with that, then that's fine. If it's too big in size, it's gonna mess with your process, and it's gonna affect the way that you trade and risk manage the position. Even if you are profitable, you're not really going to be like at ease at all until the position is taken off. And even if you book a very handsome profit, you'll still think about like, if I held on, I could have made X amount more, or like, right? So if you have it properly sized, you wouldn't cloud your psychology with these very human and like what everybody's susceptible to sort of like forces that work against you. You become your own worst enemy. For me, generally speaking, so like most of my active trading is with futures and options, but especially with options where you have a defined downside and you have an asymmetric upside potential. And so in that case, what my goal isn't to like make X percentage or something like that, or have like an X% return or like a price target, God forbid, or some nonsense like that. What I try to do, and this isn't for everything obviously, but is that my goal is to like own a position for free, essentially. So if I buy like a bunch of call options on something, let's say out of the money, and then the security moves to my strike price and like my, the value of my premium goes up, multiples, my goal is to take my initial principal capital off the table and still have enough of like a position that would be meaningful, like at least equivalent to the original sort of notional size of my original position. Which is why I'm not gonna buy just like 2 options contracts or something like that, right? Like I'll buy multiple ones so that I can do that. But if I'm able to get my initial principal capital out of the market, then I'm just playing with house money. Then I don't have any losses because I've already secured, everything. And usually I try to take my initial principal back and then some, like a small bit in addition. And then after that, I don't care, right? Like what happens to it. And then that allows me to actually trade it a lot better for the reasons I had just mentioned before, the psychology of it, right? So it's when you're trading markets, you're not really trading markets, you're trading against your own psychology. Like I just said, we always get we get the same markets and everything like that. We get the same volatility, the same insurance, and so it's the factor that makes traders that are very good, traders that are terrible. The difference is how each of those individuals actually manage their position or mismanage their position, and that is very much largely influenced by the trader's psychology. So that's generally what I try to do. So the same thing actually with my kind of core Bitcoin position. I've traded Bitcoin since the early 2017 initial sort of bubble, but in May or June or so of 2020, when Bitcoin had just flatlined and every single other asset in the world except for Bitcoin and the Turkish lira were just kind of on this face-ripping rally off of that March plunge, that's when I actually put on a serious actual holding, not a position, not a trade, but ownership, right? Portion of net worth, if you will, that I just bought and I still have kind of just stored away. Bitcoin went up 6x towards the end of the year. So at that time, I took back my initial principal and then some. And now I own Bitcoin far lower, and it's house money. So I really don't care what happens in terms of near-term volatility. And I'll actively short Bitcoin, or I'll buy put spreads or whatever it is and that's how I'm kind of able to do that. So that's just I'm not saying that none of this is obviously trading advice. Just look at my disclaimer from last time. If you listen to me, you're going to lose money. If you try to use me as a reverse indicator, you'll still somehow lose money. So just don't listen to me, because these ideas are all very stupid. I'm a very stupid person. Don't listen to me. So that's just what I do. So I'm just telling you what I do. If you want to apply it, by all means do so, and prepare to lose all your money when you do so. All right. So those three positions, I put the commensurate amount of capital into it, which was not very much because I did not spend a lot of time thinking about them. However, the one position that saved all of this horrendous kind of horrible trading is the one that I actually did put some thought into, which were the puts on 5-year U.S. Treasury futures. That is currently working out quite well. So the Treasury markets, 2s, 5s, and 10s, I mean, they got hammered. It's crazy. The amount of volume too that went through is just absolutely nuts. Let me see if I can pull this up. Okay. So in the 2 hours between when the FOMC policy was released and 4 p.m. market close, so Powell already did his press conference and all that. In those 2 hours, 2-year Treasury futures. This is just on screen too. This isn't what was this doesn't include the stuff that was blocked off exchange. 2-year U.S. Treasury futures, a little over 50 billion notional traded. 5-year Treasury futures, another roughly a little over 50 billion notional. 10-year U.S. Treasury futures, 84 billion notional traded. And then 30s, a little over 10, 13 billion. 2 hours that traded on 4 contracts, on 4 futures contracts, on 2s, 5s, 10s, and 30s. So over the course of this month, for January, there has been a huge buildup in open interest in 10-year U.S. Treasury puts for March expiry at the 127 strike. Okay, so March 127 puts on 10-year U.S. Treasury futures, as well as 127 half. The latest data is about 350,000 contracts of open interest in the March 127 puts on 10s. There are also just under 200,000 in open interest at 127 half. So like 2 ticks above 127. So there's a total of, over 50 billion notional in just those 2 contracts alone for March expiry, 127 and 127 half puts. And if you take a look at this chart that I have just made, it's 10-year U.S. Treasury futures and the 10-year U.S. Treasury futures volume on the bottom. You can see that volume spike. And then in blue is just the 10-year U.S. Treasury yield overlaid on top, and obviously it's going to be an exact mirror opposite of the 10-year U.S. Treasury futures price and price action. The 127 strike level, we are like right there, okay? The 127 half, we've already like hit, basically. But if the market were to trade through that, right, and just continue to fall below, then you would have seen like this wave of futures selling because of this huge outstanding put options open interest position that's been like kind of building up over the last month. And if the current like 10-year yield is just under 1.9%, and it hasn't hit that 127 level yet, then if it cliff dives through 127, you're going to see 10-year yields at or above 2%. I mean, like, we came very close to that already. And those positions didn't disappear. This is for March expiry, but that means that they expire February like 18th or something like that, somewhere around there. Or 50 million, notional spread across just 2 strike prices, for which the current spot market is like right there already. Like, we are basically sitting on a knife's edge right now. Like, 10-year yields they just need to get shoved a little bit more, and they could potentially blast to and through 2%. And if that happens, that's going to, that's the risk-free rate. That's going to move global cross assets. So I just want people to be aware that the Treasury market is on a very like kind of teetering on an edge right now. I'm sure that the 2% level has like a wall of like buying and like limit orders like kind of just sitting there waiting to be filled. But that's just kind of random speculation on my part. Who the hell knows if that really is the case. But if Treasuries like scream through 2%, we're living in a different world in markets, right? And so this is exactly why I bought these 5-year Treasury puts, because I don't want to buy puts on the 10s, because clearly the implied volatility is being bid up right now because of like positions like this. And on the other side, at the front end of the curve, like 2-year Treasuries, those are really tricky to trade options on, because there is no vol. Like they don't move, but when they do, volatility premium is just way too expensive. Like in an instant already, you can't. It's really hard to to see like a super convex move at the very front end. So essentially, I can't buy either of those. But the Fed is pushing front end yields higher, right? So there's that force going on. And then at the long end, I have this potential, gamma flip in which, you could see 10-year yields explode to and through 2% because of these, these massive options outstanding positions. So if either of those go off, or if both those go off, and you see like front-end yields rise, or you see 10-year yields rise, or you see both, then 5-year yields are going to also skyrocket, and therefore 5-year treasuries are, futures are going to sell off, and that benefits my put position. So that's why I went long those. And so you could also tell too that I obviously put in a lot more sort of thought into this particular trade relative to the other loser trades that I had. And that's why I was able to size this accordingly, larger, because I know what I'm talking about more. It's not just like dart throwing. So I allocated the appropriate amount of capital. Just be aware that FOMC may be over, but these March options, they don't expire in March, by the way. They expire in February 18th. So we still have basically like a little bit less than a month left, but this options like outstanding like open interest is going to just be there. And because we're right there, right at the money, they're probably not just going to get closed out suddenly. Like, I think there was some profit taking I saw earlier. It was like, let's see, there was about, okay, so 20,000 contracts were closed, which would be a lot normally, but it's less than a tenth the size of just one of those two strikes. So just be aware that the current risk-free rate, 10-year U.S. Treasury yield, is a powder keg. It's a powder keg that's just kind of sitting there. So a powder keg in and of itself is not very dangerous, but it gets dangerous when people are starting to light matches and flicking it over in that direction. And that's kind of what's happening right now. They have until February 18th to just continue to keep flicking matches that way. And if one of those matches happens to hit the right spot, that powder keg could be, a pillowcase full of bricks to the Treasury market, and therefore to many other cross-asset markets as well. All right, that's it. And remember, other than what I just said about the 10-year Treasury put positioning, if you listen to me, you're going to lose all your money. And then if you try to use me as a reverse indicator, you're still going to somehow lose all of your money as well, somehow. Cool? Cool. Thank you, Mr. Powell.